Imagine waking up one morning and discovering that a company older than the light bulb, older than the telephone, older than electricity in most homes had collapsed overnight. A company so entrenched in the American financial system that its fall felt like watching a skyscraper crumble in slow motion, shaking everything around it, sending shockwaves through the entire global economy and dragging millions of innocent people down with it. This isn't just a story about money. It's a story about unchecked ambition, dangerous confidence, and the illusion that giants never fall. This is the true story of how Lehman Brothers, once one of the most prestigious financial institutions in the world, went from unstoppable to extinct. Welcome to Wealth Nexus, the rise of a titan. To understand the collapse, you have to understand the empire. Lehman Brothers began in 1850 as a small dry goods store run by three immigrant brothers in Alabama. Over time, they shifted from selling goods to trading commodities, and then to financing them. They didn't just trade cotton. They helped build the American cotton market. They didn't just support industry, they financed railroads, oil companies, and some of the biggest businesses in U.S. history. By the 20th century, Lehman Brothers wasn't just a bank. It was history. It was woven into every major economic shift: industrialization, the rise of corporate America, World War II, the tech boom. Investors trusted the name so deeply that for decades, it felt impossible to imagine a world where Lehman didn't exist. But behind every giant is a truth we often forget. The bigger something grows, the more violently it can fall. And Lehman Brothers was growing faster than ever. The seduction of the housing market in the early 2000s, the U.S. housing market wasn't just booming, it was exploding. Interest rates were low, banks were lending freely, and more Americans were buying homes than ever before. Wall Street saw an opportunity too big to ignore. Mortgage loans, especially the risky ones, became the hottest product in finance, and Lehman Brothers wanted to be the king of this new empire. They began buying mortgage lenders, bundling home loans into complex financial products, and selling them to investors around the world. These products, known as mortgage-backed securities, were supposed to be safe. After all, they were backed by real homes and real people making real payments. But here's where the seduction turned into danger. To keep profits high, lenders started approving loans for people who couldn't afford them, people with unstable incomes, bad credit, or no verified financial history at all. These loans became known as subprime mortgages, and they were ticking time bombs disguised as gold. Lehman didn't just buy these mortgages. Lehman embraced them. The firm loaded its balance sheet with billions of dollars in risky housing debt, convinced that home prices would keep rising forever. It was greed covered in confidence, ambition disguised as innovation. And it was the beginning of the end. The illusion of invincibility. By 2006, Lehman Brothers was reporting record profits. Their executives were celebrating. Their stock price was soaring. Their aggressive push into the housing market was paying off, at least on paper. Inside the company, there was a culture of absolute belief. A belief that they were smarter than everyone else, that they understood risk better than anyone, and that the housing market could never truly collapse. This confidence led to a dangerous level of leverage. Lehman borrowed massive amounts of money to invest even more in mortgage-backed securities. For every dollar they had, they were borrowing up to 30. That meant if the market shifted even slightly, the impact would be catastrophic. But no one inside wanted to hear about risk. Warning signs were ignored. Concerns were dismissed. Anyone who questioned the strategy was shut down. The company had built a billion-dollar castle on a foundation of sand, and the tide was coming in. The cracks began to show. In 2007, the first tremors hit. Mortgage defaults began to rise. Homeowners, especially those with subprime loans, couldn't keep up with payments. As people began to default, the value of mortgage-backed securities began to fall. For most banks, this was a warning. For Lehman, it became a nightmare. The assets they had once treated like gold were quickly turning worthless. And because their entire balance sheet was built on borrowed money, even a small drop in value meant massive losses. Inside the firm, panic began to spread. Executives scrambled to reassure investors, regulators, and the market that everything was under control. But behind the scenes, they were running out of time. Each quarter, the losses grew worse. Each day, investor confidence slipped further. Lehman Brothers was still acting like a giant, but it was bleeding from the inside. Denial at the top. As the crisis deepened, the pressure fell squarely on one person: CEO Richard Fuld. Fuld was a legendary figure on Wall Street, intense, uncompromising, and fiercely loyal to the firm. But he also had a fatal flaw. He refused to admit reality. Instead of cutting losses early, he doubled down. Instead of reducing risky assets, he protected them. Instead of accepting outside help, he convinced himself the firm could survive alone. This denial created a culture of silence. Executives sugar-coated reports. Losses were hidden inside complex accounting maneuvers. The leadership continued telling investors that the worst was behind them, even as things grew worse every day. Lehman didn't just fail because of bad investments. It failed because the people in charge couldn't face the truth. And by the time they realized the scale of the disaster, it was far too late. The final days, by early 2008, Lehman Brothers was on life support. Rumors were spreading across Wall Street that the firm was insolvent, essentially bankrupt, but refusing to admit it. As fear grew, clients pulled their money. Investors sold off shares. Lenders refused to extend credit. A bank that once seemed invincible was crumbling in front of the world. The government stepped in to help broker a sale. Meetings were held all night. Rival banks examined Lehman's books. But when they saw how toxic the mortgage assets were, everyone backed away. One potential buyer after another refused. No one wanted to take on billions in unpayable debt. The clock was ticking. The markets were watching. And then the moment arrived. On September 15, 2008, Lehman Brothers filed for bankruptcy. It was the largest corporate bankruptcy in U.S. history. In an instant, 158 years of legacy evaporated. Employees packed boxes. Markets collapsed. Global stocks tumbled. The financial system froze. One failure had triggered the start of the Great Recession. The shockwaves felt around the world. Lehman's collapse didn't just break Wall Street, it broke the global financial system. Banks stopped lending to one another. Credit lines dried up. Businesses couldn't secure funding. Millions of people lost their jobs, their homes, their savings. Countries across the world fell into economic crisis. Families who had never even heard of Lehman Brothers felt the consequences of its fall. The event reshaped politics, economics, and financial regulation for an entire generation. New laws were introduced, oversight increased, and the term too big to fail became a bitter reminder of how fragile the system truly was. Lehman's fall marked the moment the world realized something terrifying. Even the strongest institutions can crumble. Even the oldest giants can disappear. Nothing in the modern financial world is guaranteed. The legacy of Lehman Brothers, the collapse of Lehman Brothers, left a legacy that still shapes finance today. Beyond the immediate chaos and economic pain, it exposed the fragile web of global banking, the dangers of complex financial products, and the human tendency to chase short-term gains at the expense of long-term stability. Regulators, investors, and institutions learned the hard way that no company is too big to fail. Policies were rewritten, stress tests became mandatory, and transparency became more than a buzzword, it became a survival tool. But the legacy isn't only in rules and regulations. It's in memory, a stark reminder to every investor that blind trust, unchecked ambition, and overconfidence can bring down even the mightiest empire. Lehman Brothers didn't just collapse, it taught the world that financial giants, no matter how invincible they seem, are always vulnerable. What Lehman really teaches us looking back, the collapse of Lehman Brothers, wasn't caused by one decision, one person, or one bad investment. It was caused by a chain reaction of greed, denial, and overconfidence. It teaches us that growth becomes dangerous when it's built on debt. Confidence becomes deadly when it blinds you to risk. And success becomes fragile when leaders refuse to face reality. But perhaps the most important lesson is this. Markets don't crash because of numbers. They crash because of people, human decisions, human mistakes, human arrogance. The 2008 collapse wasn't an accident. It was the result of 1,000 warnings ignored. And it changed the world forever. Lehman Brothers was once a symbol of financial power and institutions so old, so respected, so deeply woven into the fabric of American capitalism that its collapse seemed impossible. But nothing is impossible, not when greed runs unchecked, not when warnings go unheard, not when ambition outruns wisdom. If this story shows us anything, It's that the greatest risks are often the ones we choose not to see. Thank you for watching Wealth Nexus. If you want more powerful deep dives into the biggest financial stories in history, make sure you stay tuned. The world of money is full of secrets, and we're here to uncover them.